Good morning, Richard Calhoun, Creekside Realty. We're here to discuss Silicon Valley and the Greater Bay Area. This is a summary chart showing all the different key metrics, all the different micro markets down the left-hand side. The concept here is you can either look in the geographical area that you're looking in and find out the market conditions, or find out your price point either by payment over here on the far right or the sold price. The payment doesn't have a rating because it would be the same as the sold price, as the formula for ease is the same. So going into the first heat map, this is looking at the active inventory compared to the 10-year norm. And basically you can see we have a red color, which would be a hot marketplace. That means we have less inventory than we normally do. And you can see that a lot of these numbers are basically between about 66% and 90% of the inventory you'd expect. There's some exceptions like Saratoga, Los Gatos at only 52%, but generally 60% to 90%. There's also some exceptions in the other direction in San Mateo County. Foster City, Redwood Shores has 110% of the inventory. The expensive areas have 106%. You can see that I would consider anything from about 88% to 112% to be normal. So that even though it's above, that would be normal, and that's why they're white in color. Now we're flipping over and looking at the other side, the buyer side. And again, there's a shortage of buyers, so there's a shortage of offers. But when you have a shortage of offers, that's a cool marketplace that's favoring the buyer. This is about the only condition that's favoring the buyer. Basically, there's just not a lot of activity, but there's not many sellers either. So now what we're doing is looking at the ratio of the two compared to the DUI. But we're looking at DUI, and is it normally hotter, which would be a lower number. And for most of Santa Clara County, it is hotter now than it typically is based on the 10 years we go through. San Mateo County is cooler than it normally is. Alameda County, I don't have the data, and that's why it's grayed out. And I will work on that, but it's going to be several weeks, if not longer. Moving on to days of unsold inventory. What the difference is the last slide was comparing, like the first three slides were all comparing the current data to the 10-year median, just telling you whether it's hotter or colder. Now we're looking at absolute numbers. In absolute numbers, I consider anything from 40 to 80 days to be a balanced market, less than 40 to be a seller's marketplace, and above 80 to be a buyer's market. You can see the vast majority of the map is red, which means it's basically a seller's marketplace. The exceptions are the expensive areas in Santa Clara County are sort of in a balanced marketplace, and the expensive areas in San Mateo County are favoring the buyer right now, and the coast is favoring the buyer just slightly, but close to a balanced marketplace. Now, for those that are having a trouble with some of these less concrete concepts, this is pretty concrete. We'll take the time that it takes to sell all the properties, line them up in a column, and we look at the 75th percentile. So if you had 100 transactions, this is the 75th longest property to sell, and those are the times. So basically, I'm saying from 1 to 3 weeks would be a fast seller's marketplace. And you can see in Santa Clara County, most of the time frames are right around 2 weeks. You go over to Alameda County, right around 2 weeks. And you go into San Mateo County, and you're either right around 3 weeks or you're up around 7 weeks. And that's why San Mateo County is white. 7 weeks is just about where I start coloring it blue. So 49 days is 7 weeks. 53, there should be just the slightest shade of blue here, and I'm not sure there is. There's a slim possibility I don't have my formula set up yet for a buyer's marketplace on the 75th percentile days on marketplace. Moving on to price reductions, and this is really valuable to know because it gets away from the time lag that we have waiting for escrows to close. Escrows are basically 35 days in duration, and when you start looking at sale price to list price ratio, that means you're back an extra 5 weeks. Where if you're looking at what the sellers are doing to the list price, you know that right when the offer gets accepted, so there's no delay. The disadvantage of the number, it's very tight. Basically, you can see that all these numbers are very close to 100%. You rarely go over 100%, but we have at least 2 and probably 3 areas here that are over 100%. And that means sellers on average are actually raising their asking price up a little bit. Now, they're not great amounts, but you wouldn't expect them to be. But again, the concept's the same. The blue areas, the coast, is where the sellers are taking the most reductions, but it's really not huge. It's only 2.7% of a price reduction. And even in the expensive areas in San Mateo County, where we were in a fairly strong buyer's marketplace, the sellers are only taking a 1.5% price reduction. So price reductions are a very tight metric, and I don't know of anybody everybody else that looks at it, but I still think it is a valid metric to look at, and I don't know why more people aren't looking at it. Now we move over to the frequency of ask price reductions. So the other one, the first slide was the magnitude. Now we're looking at how common is price reductions. And you can see most of these numbers in a lot of the areas are single digit, i.e. under 10%. The highest number I'm seeing is at the San Mateo County coast, where 30% of the sellers are doing any price reduction whatsoever. Now it could be as small as $1,000, or it could be as much as $200,000 or $300,000 or $400,000 or $1 million on an expensive property. Then the next most highest is the expensive areas in San Mateo County, and that looks like just shy of 19%. In general, a very tight number where sellers have done their homework before they go on the marketplace. So the number of sellers that are doing price reductions is very limited, and that explains why the price reductions are such a small percentage. Now we're flipping over to looking at the buyers, going back to the magnitude of overbidding. I do magnitude first because it's a more sensitive indicator. It changes more rapidly than the frequency. Buyers will tend to reduce their amount of overbidding, but still overbid, so the frequency remains unchanged, but the average changes pretty rapidly. Again, the concept's the same. Anytime you see red or pink, you know you got a market that's favoring the sellers. Anytime you have blue, you know you have a market favoring the buyers. Basically, everywhere is experiencing overbidding. The one exception is the expensive areas in San Mateo County, where they're going at 1.7% under their asking price, but everywhere else is above, but they're not at the magnitude we were at before. I will point out Berkeley and the city of Alameda are at almost 18% above the asking price, and that's pretty significant, but it's a fairly small area and the only area that's that high. Basically, anytime you've had an insult to the marketplace, buyers tend to be more conservative on what they're willing to pay for a property, and therefore overbidding is not nearly as crazy. Now we're flipping over and looking at frequency of overbidding. Lowest areas, only a quarter of the sellers in the expensive areas in San Mateo County are getting overbids. Every other area that I'm seeing quickly is over 50%, and a lot of them are right around 2/3 to 3/4 of the sellers getting above their asking price. Now, granted, it's not very much above their asking price, but it is above their asking price. This is the appreciation since the last 9 months of 2015. That period was picked because it's a long time back and prices were pretty stable. In a nutshell, this tells the whole story, in my opinion. The areas that were the focus of convenient employment have been doing worse since the pandemic. And it's basically people are only commuting into work 2, 3, 4 times or 100% remote working. So these outlying areas are relatively more attractive, and therefore they've been appreciating recently more rapidly than these inner areas. And because they've been appreciating more recently at a higher rate, and because of compounding, that gives the overall period, because 2015 is 5 years before the pandemic, but that tends to pull up the entire period that you're looking at to be the highest, and that's what we're seeing. Here's sold price that almost everybody follows, but instead of just following the median, which is the middle number and what assigns the color, so here you can see your outlying areas are still cheaper. I also add in the 10 and 90 percentile, and this allows you to know that 80% of the properties are between the outlying numbers and 50% is the middle of the median. Here we're back to the summaries. Again, the concept is you pick the micro market area here and look at your different metrics. The gray is because I don't have the data. I will work on that, as I've said. You can sort of get a snapshot on this one slide of what's going on. The other one gives you sort of the macro view. This gives you the micro view. And then to get a real micro view, you do a CMA on a property, and you can get down to the zip code level, but as the zip code level on statistical data is garbage because there's so few properties. At times, I even question my 1E micro market areas as being too small, but they're homogeneous, whereas zip code, and by homogeneous, the characters of the property are the same. And I've grouped them intentionally, but I had to group multiple regions together. So I have several zip codes, and they're still a little bit marginal sometimes unfluctuating. Now what we're looking at is simply Silicon Valley. So we're looking at the 3 counties, Santa Clara County, San Mateo County, and Alameda County, all in a blender. And then what we're looking at is inventory, the purple line. Right now, the 3 counties only have 63% of the inventory you'd expect to have. They have 73% 40% of the offers that you would expect to have. That gives you a DUI faster than you would expect of 88%. I use the word offers. A lot of people use the word pending. There is a huge difference, and I will argue all day long that using offers is superior. The problem with using pending transaction, you have a cash transaction. It's just as valid as a loan transaction. It may close in 3 days or a week, and therefore the period of time that it's a pending transaction is much smaller. You take a loan where you have to go 5 weeks, it's in there for 35 days. You have a loan that was difficulty or had some hiccups and you go 7 or 8 or 9 weeks, that property that had the difficulty counts as a pending transaction for a longer period of time, and that makes no sense whatsoever. So I count each property one time for the same period of time, which is 35 days, which is 5 weeks. Now what we're looking at is, to me, one of the things that I think is key is we're basically having record low volume, and it's not record low by a little bit. We're basically right around 70% of the previous 10 years. The concept is these are record low years. So whether it's a record low by 5%, as this data indicates, or if it's a record low by 10 or 15%, it's still a record low, and it's a record low not by 1 or 2 homes. It's a record low by a significant amount. And I think that's important, at least, for anyone that looks at the stock market. They always talk about the volume of transactions. Now we're slipping over and looking at the estimated payments. I did this sort of as a request. Initially, when the market was slowing down in 2022, payments were going up, but the market continued to slow down as payments were dropping. The market was slowing as payments were dropping, so it was not an affordability issue. Basically now, if you look all your different areas, whether you're looking at the 10 percentile, the median, or the 90 percentile, they're all payments above where we were in 2023. The payments are higher now. House prices are lower, but house prices have caught up enough now that payments are higher now than they were in 2023, and most people pay by payments. And just look at the steepness of the 90 percentile property going up. The median is a little more reasonable, and the cheapest 10 percentile is even flatter. On log paper, I would almost wager they'd go up the same slope, because that's what would make logical sense. But you can see how flat payments were from 2018 all the way through 2021, and that was because interest rates were on a gradual decline. So even though home prices were going up, the payments people paid were going down. Now we're going to look at the seller's ask price reductions, and I've done away with the up and down arrow so you can focus just on the bold line. When they're dotted, they're a month, and then we flip over to dashed lines, which are monthly, and then weekly are dashed lines. So here we go. One of the things I'll do, if no one is able to convince me to put the arrows back in, I will redo these tables to try to keep them in exactly the same spot so there's no bouncing around. That was one of my motivations for getting rid of the up red arrow and the down blue arrow, is every time I did it, I risked moving the graph and they got offset a little bit. Now we're doing the same thing where we're starting off with dotted lines being the oldest data monthly, then we'll go to dashed lines, and then we go to solid lines. This is the best month we ever had, which was basically, I think it was March 29th of 2022. Yep. And then this was basically right after the World Trade Center, November 30th of 2001. And we'll step through, and you can see you're jumping down. And you can see there's a lot of plateaus. Basically, the market's been stable for a little while with an improving trend up through here, but the weekly jumps from week to week have been pretty minor. We're stable right now. This is one of the first indicators that I'd expect to start going down, but now there's a lag time, and that's why I did the previous slide, is you really pay attention to the list price ratio, and if the list price ratio starts declining, then you know that the market's slowing. Now we're looking at Silicon Valley as a whole. We're looking at, and the concept is the same, the red line is the hottest 10%, the gray line is the median, and the blue line is the coldest 10% or the coolest 90%. With inventory, it's a high number, so it's a cool 90%. And so you can see that we've had 3,400 homes on the market at times. You'd expect 3,000. Right now, we have 1827. The lowest we have is 1830. If you notice, I did bold and colored the 1827, so I knew which number went with which line, because the two lines visually look like they're on top of one another, but they're off by about just under 1%, but that's pretty darn close. So we're basically having about the least amount of inventory you'd expect based on the last 10 years. Now you're looking at the number of offers, and again, I'm using the word offers, not the number of pendings. To me, pendings makes no sense. The reason the vast majority of people quote it, that's what the MLS puts out, and they do that for convenience. Yes, it is more work to find out when the sale date was and use it based on their sale date versus just their status, but you get way more data, and that was the reason I got into the data crunching back in 97, was the data produced by the MLS, in my opinion, and I think I can back it up, is basically garbage. And you put garbage into your data, you get garbage out no matter how good your processing is. But anyway, right now our inventory, our number of offers accepted is 2050, just 2,050 roughly. The lowest you'd expect is 2156. We're basically 108 offers less than the least you'd expect. And that's the thing that nobody seems to be talking about. They talk about the speed of the marketplace, but there's no volume behind it. And I think that the pandemic again makes sense. When the pandemic hit, everybody's needs changed. There was a huge spike in the volume of transactions. So now you have to pay the piper because people accelerated their buying purchases. So now you have a lag. And so of course you have a less of transactions. So I'm not sure that this lack of transactions is as big as the deal that it normally would be, but at least it should be mentioned and paid attention to. And then the median's here at 2780. Flipping over to days of unsold inventory, this is the speed of the marketplace. The fastest you expect the market to be is 28 days. We're at 31. The typical would be 35. We're halfway between where the fastest you'd expect the market to be and where you'd expect the market to be at 35. We are in a fast-paced marketplace, even though there's not very much volume. And here's the DUI versus typical. If you were having a normal year, you'd be right on the 100%. Below the line is a faster marketplace, above is a slower marketplace. And you can see in 2022, we were in a very slow marketplace. In 2023, we've been in a fairly fast marketplace after about the first quarter. And it started accelerating even early in the first quarter, as you can see by the line coming down. Now we're looking at the more logical number, or easier to comprehend maybe, number of days on market. And then instead of using the median or the average, which most people do, the drawback of the median is it tends to be a very stable index. The problem with average is you have one person selling their house after being on the market for 2 years, which does happen. It pulls up the average without doing it. By looking at the 75th percentile, I get something that moves around a lot like the average does, but when that 2-year property sells, it doesn't impact the data. So you end up with a more statistically stable data point, which is valuable. And you can see the least you'd expect is 15. Right now we're at 16 days. So the 75th percentile seller is selling in 16 days. You'd expect it to be 17 days, so not much difference. And then the coolest you'd expect, or the longest, is 25 days. This is where we compare on a percentage basis. So we're at 88%. We're 12% faster than you would expect us to be. And that's based on 10 years. This is the average price reduction. We were way down here. This is the least you'd expect. The typical you'd expect is 99.4. And right now you're at 99.6. The hottest you'd expect is 99.7. You can see this is a very tight metric, but again, I would argue that it's valuable. And the reason I put in the blue, the gray, and the red lines are so you can see the trends. One of the things that is really important is to realize all the trends real estate has. We have a weekly cycle, we have a yearly cycle, and we do not have a monthly cycle. A month doesn't even have the same number of days. We even have a daily cycle, which is why a month makes no sense, because you have different numbers of Mondays, Tuesdays, Wednesdays, Thursdays, and Fridays in each week, and each one of them has a different thing. And you might say I'm splitting hairs. Inventory, depending on what what day of your week it is, even when the inventory long-term, comparing Monday to Monday, Tuesday to Tuesday, is stable, the fluctuation between Monday and Sunday is 7.5%. So your fluctuation depends dramatically on something as simple as what is your inventory. And I have been considering, and I have not done it, I've been considering using an moving 7-day average for my inventory to get rid of that problem, because I still have it a little bit, but not nearly as much as other people have it, because most of my data is based on the 5-week average, so I've taken that into consideration. This is the asking price reduction versus typical. So right now we're 83%. So even though it's a small number, we're 17% less price reductions than you normally would expect to have, and that is where I say there's significance. Frequency of ask price reductions. You can see that coolest you'd expect is 20%. The typical you'd expect right around 13%. And right now we're at 8.7, very close to the 8.6% least that you would expect. Again, the market's strong as far as the speed. It's strong as far as sellers not have to reducing their price. And that is typical of an increasing marketplace. Sellers tend to always want to sell for the top in the neighborhood. When you're in a declining marketplace, you have larger and more frequent price reductions, especially when the transition from an increasing to decreasing marketplace happens. Here's the frequency. So now compared to normal, so we're 70% of normal. You can see that it's down fairly significantly. Again, even if it's a tight metric to measure, when you start looking at it compared to normal and do a ratio, all of a sudden it becomes an easy benchmark, and you can see how rapidly it changes, which is the kind of thing you're looking for. You're looking for indicators that tell you and tell you early. This is the average overbid compared to normal. So right now we're at 106.5. Typical is 106.7. Darn close, but a little bit slower, a little bit larger price reductions than are normally happening. This is the frequency of overbidding. Again, frequency of overbidding is a little less common than you'd expect, but pretty darn close. 72 is what you'd expect. You're at 70. So a 2% drop, but when you do a ratio between 2% and 70%, it becomes more significant. And then here is your median sold price. And this is on log paper, so you can see the expected appreciation, and that's just freehanded in. But you can see that in 2023, we were way above the level you'd expect. And right at the end of the year, you were way below. And right now we're just slightly above the line. Everything looks fairly good from that point of view. Also notice there's a dip down at the end of every year. That has a lot to do with the geographical areas selling, not property values. So that's something that, is hard to take into consideration. It's basically a market mix things. It turns out that people that own more expensive homes tend to take the holidays more seriously. Therefore, the more expensive areas make up a smaller percentage of the marketplace. Therefore, the price drops even with property values staying the same. Now what we're doing is comparing the three components of Silicon Valley. That's another huge difference, is most people look at just the county by county, and that's what we're doing now. But that's after we started off by looking at the micro markets. We looked at the micro markets initially, then we looked at what the whole Silicon Valley is doing, because in a lot of ways it's one engine, and now we're looking at what the three counties do by themselves. You can see San Mateo County is the smallest county with 480 listings, and you can see that's just about normal where you'd expect it to be for this time of the year, which is just running in beginning of third quarter, end of second quarter. But now look at Alameda County and Santa Clara County, and you can take them together because they're basically follow each other, but we're down here at just 650 and 700. We're normally up here somewhere around 1400. That's a huge reduction in inventory. The inventory reduction that we're experiencing is not happening in San Mateo County. It's the two big counties that are having the huge reduction in inventory. Offers accepted. San Mateo County is down a little bit, but your Alameda County and Santa Clara County are down a little bit more, which is why, but not as much more. And that's why they're a faster paced market than San Mateo, if that makes any sense. So the percentage drop from here to here, it looks big, but it's a smaller percentage than the drop from here, somewhere around 575 to 385 is a bigger percentage drop, or at least the same order of magnitude. I think it's probably slightly bigger. Now we're looking at days of unsold inventory. So you can see San Mateo County County is quite a bit slower at 43 days. They're actually in a balanced marketplace. You come down to Alameda County at 31 days, that's starting to be a fairly fast seller's marketplace. And then you come down to Santa Clara County and you're at 26. Clearly a seller's marketplace in Santa Clara County for single-family homes. 75th percentile, you can see Alameda County and Santa Clara have exactly the same number at 17. I spread them out. I could have put them right on top of one another. And then San Mateo is at 24. The drawback, if I put them on top of one another, people might think I left one number out. Here is looking at the magnitude of list price reductions. I'm taking the list price at the time the offer is accepted, comparing it to the original list price, making corrections for data entries. If a property initial list price is unreasonable and is corrected within a couple days, I ignore that initial list price to try to get more accurate information. So you can see San Mateo County is doing the worst with a 0.7% reduction, followed by Santa Clara County at 0.5%, and then Alameda County at 0.3%. And it's sort of interesting that even though Santa Clara County is the faster market, it's Alameda County that's doing the least amount of price reductions in magnitude. This is the frequency. San Mateo County has the most price reductions. Santa Clara County has the next most, and Alameda County has the fewest price reductions. So again, it's a little, they're not huge differences between Alameda County and Santa Clara County, but it is a little bizarre that Santa Clara County is the faster marketplace and yet having the bigger price reductions. Here's the magnitude that we're flipping over and looking at what the buyers come in and do. And the buyers in Alameda County are feeling, and that's not what you'd expect. They're feeling more pressure. They're overbidding by almost 10%, where in Santa Clara County, they're overbidding only by half that at 5%. So even though Santa Clara County has a faster paced market, the buyers in Alameda County are acting like the market's faster. And I think what the difference is, and I don't have the data yet to back this up, is I think that even though Santa Clara County is faster, Alameda County is faster than it typically is, and therefore the buyers in that area aren't used to the fast pace, and therefore they're reacting more, where Santa Clara County is usually fast paced and buyers here are just used to it. Here's the frequency, again, the same order, which is not the order I would expect based on speed of the marketplace, but Alameda County has the most frequent overbidding at 77%, Santa Clara County 68%, and then following up at last place is San Mateo. And San Mateo is coming in where you'd expect, the least aggressive overbidding and the slowest marketplace. Here's your appreciation since 2015. You can see that Santa Clara County has really pulled away, but Alameda County is pulling up. What it really talks about is if you come back here to March of 2020, we were all right on top of one another as we were figuring out the market. But once we started remote work and everything like that, San Mateo County went to the bottom. You might argue that that's still clustered, but I would say look at how much bouncing there were, and they were completely interchanged back here, where since, a year, 6 months after the pandemic was announced and we were getting used to the new life, San Mateo County has been at the bottom of the overall appreciation. Here's your sold price on log scale. You can see going back in time, the horizontal, Santa Clara County is significantly above where we were at the latter part of 2021. San Mateo County is right about where it was, and Alameda County is right about where it was. So that's an interesting difference. This is the same information on regular paper for those that prefer. This is the payment differential. So San Mateo County payment at almost $15,000 a month, Santa Clara at $13,500, and Alameda County at $10,000. Here's the numbers for those that want it for each one of the three counties. Now we're shifting out of the Silicon Valley into the Greater Bay Area. So Silicon Valley was San Mateo County, Santa Clara County, and Alameda County. Now we're adding in the cities region, which is San Francisco Marin, the North Bay, 4 counties, the Central Valley, and the Central Coast. We're doing the reverse order by starting off with the numbers since we were just doing the numbers, and I apologize I didn't notice this error here. I will probably get that corrected next time. Here is the data of inventory. And if you look at Silicon Valley in the purple, we're down. We're from 1,800. And, you might say we're normally somewhere, around 2,800 or something like that. So we're missing 1,000 out of just shy of 3,000. So somewhere around a third. But look at what's happening in your other outlying areas in the Greater Bay Area, specifically the Central Valley and the North Bay. They're normally up here somewhere around 4,800 homes on the marketplace. And they're down at the same level. Or just look how close the three are here. You can see they're pretty close together, and look how far below Silicon Valley is in any typical year. If we think we have a shortage of inventory, go out to the Central Valley or up to the North Bay, and they have a huge shortage. And the shortage for our Central Coast and our cities region is not nearly as much, but is still there. So all 5 regions inventory is down. Now we look at the number of offers, same concept. Starting at the bottom, our cities and our Central Coast, their volume of offers really isn't down. And then you look at the ones up here, Silicon Valley is still on top compared to the others. The speed that the North Bay and the Central Valley is experienced compared to what they're normally experiencing is a huge increase, because they have no inventory, and their drop in offers is roughly the same as the drop in Silicon Valley. Here's days of unsold inventory, and you can see Silicon Valley is normally a whole significantly below all the others. And you can see right now, these 3 or 4 are all really close together. The only area that's slow is Santa Cruz, the Central Coast, and it's normally the slowest. The big takeaway I would say is everybody is moving faster than they normally are, even though we have less inventory and less number of offers, but Santa Clara County has slowed down compared to where they normally are. Looking at the time on the marketplace, the same thing. Santa Clara, Silicon Valley is normally way below, but right now you can see the Central Valley is close on our tails at 19. And, you think what's going on in the Central Valley? It's the remote work. You have new areas like the island community or whatever it's called. You have mountain house that are out there. And, those are areas that, people that want the McMansion are now commuting to and commuting into work 1, 2, 3 days a week instead of 5 days a week. And the other 3 regions are all pretty close together, from 28 to 31 days for the 75% of the properties to sell. This is the overbid magnitude. Looking at it, you can see the area that's the biggest, which is a little bit of surprise, is even though San Francisco and Marin isn't showing, it's got the most overbidding. So there's probably, since there's a lack of quality inventory up there, and when a property comes on and someone wants to live in the city, they really want it, and they're bidding up the most, followed by Silicon Valley, followed by North Bay, then the Central Valley, and doing the least is the Central Coast area. Frequency of overbidding, the order of magnitude here has changed, where Silicon Valley has outpaced the cities, but the cities is in second. So what that's saying is we're overbidding more often in Silicon Valley than in San Francisco. But in San Francisco, when they overbid by larger dollar amounts, so that the average overbid is greater. And you can see the Central Coast is the least amount of frequent overbidding. This is the frequency of sellers reducing their asking price. And I thought I caught that. This slide should have been before the buyers. We do sellers and then we flip over to buyers because of the time lag. So I'm sorry that it's out of order, but this is the frequency of sellers doing the price reductions: 8%, 11%, 13%, fairly small price reductions. Silicon Valley is the least at 9% of price reductions. So fairly close. I tried to color code the numbers over there. It was fairly hard to do, instead of saying they were all the same number, and so you can actually read them. This is the Greater Bay Area. So the 5 regions of the average sale price overbid. And you can see that San Francisco and Silicon Valley are basically, they're exactly the tie. Here I separated, even though the numbers were identical, the Central Coast is doing the least well, then North Bay and the Central Valley. Greater Bay Area appreciation. So you can see that the San Francisco, the heart of people that wanted to commute into work every day, it's appreciated the least well. And then I think up here, the yellow line is the Central Valley. It's one of the ones that's appreciated the most. I believe it's all directly related to COVID and the change in the environment. So if you can predict what's going to work out on remote working long term, I think you can do well in real estate. Here's the estimated payments for each of the regions. San Francisco Marin is the most expensive, followed by Silicon Valley. The cheapest is the Central Valley, which is why people are going out to the Central Valley. And these are my URLs. The green URL is what I call my root URL. That gets you to the YouTube on the archive on YouTube. If you add in 2023, you get to the Saturday morning presentation at 9 a.m. If you do the handout, you can go over in the handout. It is not posted. I spent this morning chasing down some gremlins, and I got most of them ironed out. And if you want a specific episode, I'm Richard Calhoun with Creekside Realty. My contact information, email, and phone number. Does anyone have any questions? Not seeing any questions. Thanks for joining. See everybody next week. Bye for now.